Happy Masters Week. I guess the Masters is over at this point, so hopefully whoever you gambled on or were rooting for, in fact, won the tournament. And welcome back to another episode of the Lone Star Capital podcast. Very excited to go through to discuss all the fun market volatility in the crazy world that we live in right now. It feels like you check your phone, you refresh it, the market's down 10 points, and then you refresh it and it's up 11. So what a time to be alive during a very precarious and bizarre point of the market cycle. But I'm here with Rob Beardsley, CEO and founder of Lone Star Capital. Myself, Craig McGrouther, the Director of Business Development here. Excited for a fun show for you today. But before we get into the meat and potatoes of the show, we're going to be pumping this all day long. We are very excited for several events we've got coming up here. First things first, we've got our Bay Area Lone Star West Summit event, really geared towards passive investors, I would say, specifically. Some capital raisers probably going to be there, but mostly for passive investors, I would say that event is for that. And then naturally, the 5th edition of the Lone Star Capital Summit, the LSCRE Summit in New York City, September 14th and 15th. The dates, by the way, for the Lone Star West Summit is April 25th, but the New York City Summit will be September 14th and 15th. That will be the melting pot of all things commercial real estate, particularly in the investments world. We're going to have the best debt people, the best sponsors, the best equity sources, high net worth individuals, family offices, capital allocators, you name it. We're going to do it bigger and better than ever before. So we're super stoked for that. This event is highly curated, application and invite only. Funny enough, yesterday we were going through some people whom someone on this podcast said, nah, I'm good on for attending. So we do gatekeep this event. It's not just anyone who's got a pulse that wants to spend $2,500 can come. We do take the room very seriously. We would never want to dilute it. And we take very, very seriously who we allow into our circles and such. So when the judge, jury, and executioner says no, not much fighting I can do to help you there.
Someone's got to control the door.
Exactly. Well, he treats it like a nightclub out here. I'm just trying to make this thing, more profitable so we can give more money for the incredible foundation that we're benefiting, which is Paul Hutchinson's foundation to help children being trafficked throughout the world. So obviously we've got a very big and deep and important meeting there, but we're super thrilled for the people who have signed up. I think we've already got 50 people RSVP'd, which is awesome. So it's a third way to the goal. The goal is to get to 150 people here this year, but I can assure you from the sample of people who have already RSVP'd, from the sponsors that are doing this is selling like a hotcake despite the turbulent market. But I think a lot of it has to do to the fact that people are really valuing relationships more than ever. A lot of people have got their equity sources tapped out. A lot of, call it equity shops who, have got powder are not really maybe happy with the current groups they're working with, or maybe they're looking to meet new people. I mean, I've seen that a ton. I've seen institutional people constantly checking in our pipeline, things like that. So that said, we've got a really incredible list of people who will be coming, people ready to put out capital, people who are ready to make deals. So please, if you are interested in maybe coming to that event, reach out to myself, Craig, Craig, at LSCRE.com. We can see about getting you maybe in the event for a full price checkout, or maybe if you're a big player in the space there, if you will, with regard to capital raising, perhaps you can get yourself a free entrance. So you never know, but reach out to me. We can help you. Any other 2 cents you want to add to that, Rob?
Yeah, sure. If anyone wants to skip talking to Craig and just go straight to the website, they can go to lscsummit.com and get more information as well as apply.
I love it. Awesome. So as I kind of teased here, we're going to be talking about the fun world of the markets right now. I don't even know where to start here, but some of the themes we want to go through here is kind of just volatility and the markets. So Rob, kind of lead the way with what's happened. And I just want to preface this statement. It is Thursday. We typically record Thursday and then release it the following Monday. So it is April 10th right now. The world is moving at such a crazy pace that I feel like you have to take and timestamp kind of the podcast and stuff because you say one thing and then it could be totally wrong. For instance, if we recorded a couple of days ago, the market would be in the dumps. And then sure enough, I think there was a 90-day pause on tariffs. And next thing you know, the markets absolutely ate that up. So there's so much movement going on. It's hard to kind of make sense of things. But that said, why don't you talk about the volatility in the markets right now, Rob?
Yeah, sure. So I like the word volatility because it's kind of the opposite of one of our core missions at the company, which is to help you sleep well at night. And of course, I like to sleep well at night too. So it's serving me, it's serving you, it's serving our investor, it's everyone. So we're very big sleepers over here. We want to sleep very well at night. I've got my Aura ring tracking my sleep scores, and volatility is typically not so great for your sleep. And so that I'm bringing this up because we're learning a lot in this period of time. We've gone through just generally a volatile period of time, and not just volatile, but also a depressing period of time. Values have been mostly trending down, not up, and same as fundamentals. And obviously, that's just difficult to deal with from an investment standpoint. And when we talk about sleeping well at night from an investor standpoint, investing is risky, investing is stressful. You're betting on your nest egg to not just grow but also stay intact and to be able to serve you and your family, and be that strong brick wall. So in times of volatility like this, when market's up, market's down, market is down big 5% today, so it kind of gave back a lot of the gains from yesterday. It's just such a whipsaw. Like I said, that's stressful. That doesn't necessarily help you sleep well at night. And so I'm not going to make the cheesy pitch that real estate is less volatile than the markets. That's absolutely not true. That's not the case. Just because real estate is a private asset and it doesn't have a ticker symbol outside of it, you're on a billboard, doesn't mean it's not going up and down in value similarly to the stock market. The stock market just has instantaneous pricing, and therefore you can actually just stare in the face of that volatility much more in your face about it. So we are learning through this experience about the types of assets that we want to own, how we want to manage them, how we want to manage through times like this. And it is making us more prudent overall and more strategic to combat volatility like this so that we can truly deliver on this core mission and promise to our investors of helping you sleep well at night. And yeah, that's kind of just a high level thought. Just want to kick it off with that piece that, we're not there today, but my life goal is to help people sleep well at night.
Yeah, well, hopefully you can get everyone an Aura ring and some Brian Johnson meal preps and olive oil and such to make sure that they can live a little more holistic and healthy life. But with that said, I know it is a very turbulent time right now because a lot of people, particularly investors that we work with, are folks who are looking to probably quasi-retire, are retired on the path to retiring, and well, retirement's a lot more comfortable when your investments are doing great. And when you see the volatility in the stock market, it's kind of concerning. And then when you also see, frankly, the evaluations of some of these deals with maturities coming up, or if you bought a riskier structured deal, you're looking at the deal being price A and then now being price B, and price B from 4 years ago, maybe 3 years ago on your extend is not looking so fruitful. So it's a very difficult time, and investing is emotional. Investing comes with risk, and a lot of times I think people look for investments like this, the alternative space, to kind of hedge some of their market beta returns. Maybe they want to outperform it, or maybe they just don't like the volatility of seeing the stock ticker there. But you really hope that people choose the right sponsors. You really hope that people kind of take some of the guesswork and the volatility in markets like cyclicality, cyclicality out of the game there by putting the right debt and equity structure on it. And as you mentioned, your goal is to help people sleep better at night, which I'm sure selfishly will help you sleep better at night. And I think one way you do that, of course, is as we learn the lessons of this market cycle, as these things do happen, we are, of course, being a little bit younger, or those who are living through and are experiencing and feeling it. I definitely think we're excited for the next time the market gets really hot for selfish purposes. We can make a we can make a good amount of money when that happens, but also we can also protect our investors from the downturns as well, which is putting the right debt and equity structure on deals, putting the right structure on these things to make sure that if we hold a deal, which let's say if we buy a deal today and then we sell it and then we 1031 exchange the next deal, there's a very good chance that deal, deal A that we buy today and then trans into deal B, will likely get caught in a market cycle of sorts. So it'll be us to make sure we put the right structure on there, that everyone is hedged for a downturn, but can also take advantage on the upswing if the market keeps humming.
Yeah, that sounds good. I'm going to do a quick, this is a little tangential, but I'm going to share my screen. Oh, you know what? This is a new computer. It's not going to,
You got a new Mac, huh?
yeah, I did.
What happened?
Oh, well, they just came out with a new one. So I wanted to,
Did you get the new chip? I thought you got the. Is it a new?
oh, yeah, it's the new. I got the M4
Wow. So I'm over here with this old tech, all this heinous technology, while you've gotten lapped on me
I'm
twice.
leaving you in the dust. So it's beautiful too. The new blue color, gorgeous. So yeah, you got to
Hey,
get
how
it.
about this Kelly Green?
Yeah, yeah. No, the Master's Green. You got to get. You got to buy your Macs. You got to get your iPhones quick before they double in price because they're not going to be able to make them and get them from China.
That's true. Well, then they are developing them hopefully soon enough in Arizona with TSMC.
Yeah. So I would share my screen, but we'll do that next episode once I get that
You
permission.
can send me a link and I could share it potentially.
Sure,
Unless somebody
sure.
else.
I'll send this across. So basically, what it
You
is.
know how good I am at tech support.
For sure. So this is a good chart to look at because it's in a way more informative than the actual price of stocks. And this is a simple chart of the PE ratio for the S&P 500.
What is that? Because you've talked about this before and you've explained this to me, but I think it's so funny. I've got all these golf ads coming up on this, so it doesn't look as good. Okay, very good. You've talked about this before, and it's like a good metric, right? It's like you think about cap rates in reference to multifamily as a metric, but then you've got PE ratios when it comes to the stock market and stuff, right? So does this kind of have to do with EBITDA? Kind of something like that, right? How people kind of look at businesses and stuff. Is that a fair way of maybe kind of dissecting these things to try to make it more apple to apple?
Yeah. So basically, if I told you like, oh, that deal's worth 50 million, that doesn't really tell you much because you don't know how many units it is, you don't know anything about it, you don't know how much income it produces,
The
right? And
location.
yeah, so with the S&P 500, so basically with real estate, if I told you, oh, that deal's a 5 cap, right? That tells you a lot about the deal rather than saying, oh, it's 50 million. So similarly with the S&P 500, a PE ratio is the price to earnings ratio, which basically means the price of the stocks, in this case, the S&P 500, which is the 500, biggest baddest companies, and it's the price to the earnings ratio. Earnings being EBITDA, which is earnings before interest, taxes, depreciation, amortization. So kind of EBITDA is basically income. For the purposes of this discussion, we'll just liken it to NOI in real estate. And so if I told you that a stock or the S&P 500 has a 25, a PE ratio of 25, that simply means that the price is 25 times the NOI of the S&P 500. And if I flip that ratio on its head, it's a 4% cap rate because 25 to 1 ratio is 4%, right? So here you can see this is telling us that the S&P 500 is trading at 27.4 PE ratio, which is right around a 4 cap, right? Which is right around 4% in terms of the value of the stocks relative to the income. So is a 4 cap, and this is 27, so it's a little more than a 4, it's a little less than a 4 cap, right? It's like a 3.9 cap or something, right? So in real estate today, even the highest quality real estate is not trading at a sub 4 cap. We're bidding, and it's very sad, but we were just bidding on a very good location deal in Houston, super hot bidding process, really just amazing premier real estate. And it is looking like we did not get awarded the deal, unfortunately, and it's looking like the high bid is paying around a 4.6 cap. So it's, and you can't look at these two 1-to-1, but you can see, okay, and I would argue, okay, what's better, owning a basket of 500 of the biggest, best companies in the world, or that deal in Houston? I would say, well, obviously S&P 500 is better to own,
Well, you get,
right?
about a 60 basis point advantage on that technically from there is kind of what that would be explaining, right?
Well, Well, no, you're paying a premium, right? So you're paying a lower cap rate for the S&P 500 than the real
Right.
estate,
Yeah.
right? But I think it's warranted because you're actually getting 500 of the best companies, and also what's going to grow faster, the NOI of this property or the NOI of Apple, Google, Facebook, Nvidia, right? These are high growth companies. And I think they generally are just structured to grow at a faster rate than real estate. It's just, it is what it is. I mean, maybe it's a little more volatile and stuff like that. But the brilliance of the S&P 500 is you're always invested in the best 500. So if a company goes out of business, like if Apple went bankrupt, well, the S&P 500 wouldn't turn into the S&P 499. It would just bring in the next best and to keep it the 500. And it's, guess what? It's doing it tax efficiently. So you're able to
It does
actually,
the work for you. Yeah.
it
You
does
don't
the work
think
for
about it.
you, and you're not paying taxes on selling Apple and bringing the better company in, and so on. So, I mean, these index funds are truly remarkable, and one of the best places to put your money. So even though we're real estate people, we're not saying stocks are evil, right? There's other kind of companies in our space that constantly are on LinkedIn preaching like, sell your stocks and invest with us, and the stock market's volatile, it's not serving you.
Yeah, I actually love your take there and your perspective on the matter because, quite frankly, if you did invest, let's say, in the stock market in 22 compared to multifamily deals, you'd probably be a little bit happier with your stock market option than your multifamily opportunities because the stocks have been up since then, despite this little turbulence there. Particularly with the stock market that kind of that dropped, I want to say at some point there during that point when the recession, when there's a little bit of a tech recession there, a lot of cutting, Meta laid off a ton of people, stuff like that, right? But you get really great liquidity. You have control of it. That obviously is why maybe the returns are slightly stymied here. But generally speaking, the SP 500 is a great option. Hunter Thompson was actually making and had a rant about this, how like kind of calling out everyone for saying like you're not now just all of a sudden right. For those who say how bad the stock market is, which is super true. Like there's a place and an allocation for everything there. If you are on, I'm talking now, you, the passive investor, and even if you're a fund manager, capital raiser listening to this, and you kind of use this thing all the time, when you start diminishing that too much, it almost comes off as too salesy, and there's a ton of value there for a reason. So it's not an all or nothing thing. I think it is, in conjunction to your portfolio. There's a place for syndications, there's a place for kind of the stuff that we're doing, and there's of course a place in everyone's portfolio for options like the S&P 500, options like great index funds, or if you're super bullish on a stock, I'm think maybe investing in stocks specifically is a little bit crazy, but let the S&P 500 do the hard work for you there, and have them kind of choose it accordingly.
Yeah, totally agree. So yeah, so there's one comment I wanted to make. So if you look out at this really amazing chart, because it goes back to the mid 1800s for the S&P 500, which I don't even know if the S&P 500 actually even existed back then, but uh, nevertheless, if you look at it, you can see that basically over time, well, it shows you actually, it says the mean S&P 500 PE ratio going back forever essentially is 16, right? So that's a very common number that people refer to, and they say, oh, well, isn't the average PE ratio 16? So meaning if the PE ratio is above 16, stocks are kind of richly valued, and if it's below 16, then it's undervalued. But here's the problem. Number one, the capital markets have developed so much, even in the last 30 years. The capital markets are remarkably different today and more accessible, right? Everyone's got Robinhood on their phone, and everyone can buy the S&P 500 with a click of a button. So there's more access in the capital markets. Also, what the S&P 500 is comprised of is completely different than before, because before you had like Ford and these big companies that were kind of like slow growth but stable. So of course those would trade at lower PE ratios because the growth is lower. And today the S&P 500 is almost all like
Tech.
all tech, and it's all
Yeah.
super growth, right? Because even though it's 500 companies, 30% of the actual dollar weighting is in
Probably the
Apple,
top 10.
Nvidia, Microsoft,
Yeah.
and all that. So you're really skewed heavily towards growth, which is going to push you into having a higher PE ratio. So for anyone saying that, oh, well, the S&P 500 should be trading at a 16 PE ratio, and if it's not, then it's overvalued. That's like the old people saying, oh, I'm going to sit around and wait until cap rates go back to 8%. So, well, you're going to sit around forever because you're never going to buy an 8 cap. Never. Okay. The capital markets are too developed and there's too much liquidity. There's too much demand. The whole world wants to invest in this stuff. Why should you get an amazing deal? Why should an investor be able to open up their app, purchase the S&P 500 and make 10% per year? 10% is way too much to expect from the stock market.
Particularly when you look at the safety of it and the work that you don't really have to do.
Yeah. So I think there needs to be a re-underwriting of expectations for the S&P 500 because there's more liquidity, so there's more competition. The S&P 500 will trade at a higher multiple forever. I'm not saying it's not going to go up and down. You can see if you click on the 20-year, adjust the chart to 20 years. So this kind of shows you more recent. You can see in the
What, so
2000.
it's a 2009, it was roughly 123.
So what happened there was basically earnings fell off a cliff, right? We went into a deep recession. And so let's make it in an understandable. Let's say a company is selling products, and then there's a huge recession, and that company is not selling any product anymore. So the company's income went from, let's say, $10 to $1, right? The company's making no money, but people who were owning the stock were kind of seeing through that, and they're saying, okay, well, there's a recession now, but we see it's going to rebound here pretty quick. So we're not going to devalue the stock down to, $10, right? Which in many cases it actually was devalued to that level. But that's just ignore that because that's just like a super crazy spike where earnings, EBITDA, fell off super hard. So that kind of forced multiples to go up because prices didn't go down in lockstep with earnings. We had such a deep.
The higher this is, the better the value the buy is what I'm
No,
gathering.
the opposite. The opposite.
Okay.
Generally speaking, right? It's the same thing as cap rates. Would you rather buy a 5 cap or a 4 cap? All else being equal, you'd rather buy a 5 cap, which, to translate it into PE ratios, a 5 cap is a 20 times ratio and
Okay.
a 4 cap is a 25 times ratio. So I'd rather buy 20 times earnings than 25 times, right?
I see.
So here you can see kind of more recent historical stuff. You can see that the more kind of updated average PE ratio is kind of in the like low to mid 20s. So it's kind of like a 4 cap, maybe like 4.5 cap. Okay. If we call it, to make a round number, 25, that means it's again a 4 cap. And then all you need to do is assume, what do you think earnings growth is? And so earnings growth for the best companies, kind of weighted towards tech, should be a like couple percentage points above inflation. So if we assume inflation is around 2-3%, and then growth on the best companies is another 2% on top of that, you're looking at maybe growing at around 4%. So if you're buying into the S&P 500 at a 4 cap, you're getting 4% per year on average in growth, talking about inflation, talking about real growth from, Apple and all these great companies. That means your total expected return from owning the S&P 500 is 8%. Right. And that, some would argue, is even an aggressive underwriting. But that is the new norm, I would say. That doesn't mean you can't buy in here and sell out there and make a killing, right? Like you said, people who bought in 2022, they're looking really good on their purchase, right? But you got to look at it over the long term. And so over the long term, it's like around 8%. And so this correlates back to real estate, because if that's kind of the new normal for S&P 500, what's the new normal for investing in quote unquote blue chip multifamily, right? And there's obviously S&P 500 is better than multifamily because you're getting diversification, you're investing in the best companies, but also real estate has tax benefits. So the pre-tax returns are going to be slightly compressed because the post-tax returns are twice as good. They're way better. And that's why people invest in real estate, is really for the post-tax return. So realistically, if the stock market should return 8, if you're investing in an individual asset that's super high quality, right, you're taking the individual asset risk, the private illiquidity risk, the return should probably be around 12%, right? Maybe 12 to 15%. I would say that is how you would kind of correlate and underwrite it back to real estate, given where we are today in the world.
Fair enough. Awesome. Any other points before we transition to the next topic?
No, that's good.
Excellent. Well, thank you so much for the TED Talk there. Switching gears here towards the next thought, which is just kind of where kind of rates are at. And, I think you also had a comment here you want to touch on maybe recession. So be curious to know what you think there. But I guess before we go to recession, I think rates with a correlation of the fixed versus floating conversation is kind of more collectively cohesive. So why don't we mention that there? Obviously, if you've been following the 10-year Treasury, it's been yo-yoing quite a bit. It was at what, 390 or so, 387 perhaps at the low, and then now it's back to what, 3 or 4.4, 4.3 roughly. So 4.361 I'm seeing right now. So pretty heinous, to be honest with you. If you got a deal locked up at that 3.9 number on the 10 or on the 7 on the 5, and you're looking at spike up, well, that materially changes your deal. That maybe means you were at maybe neutral leverage or a couple bips below positive leverage, and now you're really negatively levered. So it's very challenging to acquire deals in this landscape, particularly if you're a fixed rate borrower. Naturally, if you're floating, you're looking at SOFR plus whatever the lender spread may be. So you're not really looking at the treasury kind of movements there, the bond market movement, things like that. But buying right now is a very difficult time. So do you want to talk about the rates and then also the conversation we've been having internally, which is the fixed versus floating structure, which we've kind of, we're going to have to keep an open mind on. I think everyone who's listening to this show wants to sleep well at night, as we led the show with Rob wants to sleep well at night. And naturally, sleeping well at night is probably controlling variable costs, which is likely what? It's going to be your purchase price and your interest rate. Insurance, we can't control that. We can't control some other expense ratios, but taking control of one of the biggest variables is obviously very accretive and what kind of a lot of people are flocking towards right now, considering how they've been burnt. But that said, why don't we get into your topic there on and the thoughts there on kind of the rate environment right now currently with the variability there, coupled with the topic of fixing versus floating.
Sure. Yeah, and this somewhat connects back to our SP 500 discussion because obviously it's the economy, everything's connected, specifically when we're talking about a recession. And so I guess going back to that chart real quick, if we're currently at a roughly 27 times a PE ratio, then that's not recessionary. Like there's room to go down and to make it like a bargain. So it's not like, oh, the S&P 500 is cheap, buy now. Right? It's still expensive. And so I know it's popped up and then now it's kind of down. But if we kind of get into like depressed levels, it could go down to 20. And so meaning earnings could stay totally flat. If companies are performing the same as yesterday and everything's normal, not even factoring in a recession, like everyone's buying the same amount of iPhones, everyone's spending the same amount of money. But if investors get depressed because of a recessionary environment, you could see stocks go down quite a bit in value because they'd be trading at 20 times earnings instead of 27. So there's downside to the stock market, in my opinion, much more than to the upside. And similarly, I think that's similar to treasuries. Treasuries, like you said, crashed down to 3.9 and then they popped up for a second to 4.5, which is just, these are insane moves. But in the long run, or at least over the next few years, I think there's way more downside, meaning rates coming down, then there's really pressure to go up. So I feel comfortable underwriting at these rates today, which is actually really exciting because if we can find a deal today that we like based on today's interest rates and we put it under contract, there's a good chance that actually rates will trickle down during our escrow period so that by the time we close and lock the rate, which usually happens a day before closing, we might be looking at a much better interest rate. So that's a really good opportunity for us. And like now's the best time to be looking at deals and bidding on them because
not when they spike down, because there's the chance of it going up. Exactly.
Exactly. And so now we can't bank our business on this, right? You can't.
Well, last year we were on the right side of those, other than all but one, right? So
yeah. And so let's talk about that all but one, because what do you do as a buyer if rates go up against you so aggressively? So like, unfortunately, going back to 2023, and this is just a real big regret and just an unfortunate situation. But we had a property called 1001 Ross under contract in Dallas, and rates went up like 90 basis points on us, and it completely changed our numbers. And we couldn't, in good faith, close the deal because the deal would be completely different than what we had showed investors originally. So we tried to negotiate the price with the seller, because if we can pay a lower price, it can kind of help offset the higher interest costs. But the seller was only willing to move ever so slightly, and it didn't move the needle. So we had to terminate that contract. We had to lose a lot of money on that deal, a lot of our personal capital, not any investor capital. We just sent investors their money back and said, sorry, no deal. We couldn't make it work
And
given changes.
And just so you know, every investor, sorry to cut you off, um, just so you know, when you work with Lone Star Capital, you take zero pre-closing risk, meaning in the event that, something changes in your end, or, underwriting material changed or switched around and you're not comfortable with the deal, we're very transparent. We don't want you in an opportunity in a deal of ours so you're not 100% in love with, that you're in alignment with us there. So we, of course, we ate the earnest money deposit. We ate all the pursuit costs. That's just sometimes the cost of doing business. Not every deal, not every market break falls your way. Not every putt lips in, unfortunately. And this is one of those situations where we, as a company, made the basically the choice to walk away from a very large sum of money. And it sucked, but just know that you, the investor, you, the capital raiser, we take your dollars that seriously, and we'd rather lose money on our end, as opposed to kick the can down the line and potentially have you not be happy with the investments that you saw and that the projections we initially thought we'd be able to receive on said opportunity.
Yeah, that's absolutely right. So, but then in 2024, we again had a situation where rates went up a lot again. But this time, we felt comfortable actually pivoting to a floating rate loan. And that allowed us to save the day essentially and still have numbers that projected well and still close the deal. And so this is amazing because it speaks to our versatility and ability to navigate these volatile waters. And this is super, super critical as a buyer because rates are moving so much these days that it's very scary, not just as a buyer, to put a deal under contract because you don't know what the world's going to look like when you actually go to close, but also as a seller. Because if you're a seller and you're relying on your buyer to show up and close for you and rates change dramatically, well, the buyer could be looking for a price reduction or they could be looking to walk away. And so, one of our big pitches to the seller on this deal that we unfortunately did not get because market's competitive and it was a trophy asset, is we pitched to the seller, hey, last year we had a deal under contract and we were banking on certain rates, and then rates went up like crazy. Everybody knows it. And we
During
pivoted.
Q4, during the election and such.
Exactly. We pivoted to a floating rate loan structure, and we went back to our investors and we explained why for the change and what the change makes the deal look like. And we didn't lose a single dollar of investor capital. Every investor opted to stay in the deal after being explained the differences and the changes to the deal. So I think that spoke volumes to the seller. And I think that continues to differentiate ourselves in the market, where some other buyers might tell a seller, hey, I like your deal, but if rates move this much, I'm out, or I'm going to need a price reduction.
Yeah, and I want to be clear here with a lot of investors here who might be newer, who might be, unaware of how kind of the commercial world works pertaining to debt. Because so often people are starting their investment career or real estate career by buying a house or owning a rental property. Well, as you may know, if you have a rental property, you're typically speaking locking in 30-year fixed rate debt. Perhaps you could get maybe a different, an ARM loan and adjustable rate for a couple of years. Maybe you're going to do an IO loan, interest only loan for a couple of years, but you get a 30-year financing structure in there. And typically there's little to no prepayment penalties on these deals. It's very minor, if anything. Perhaps if you get certain structures with kind of a DSCR loan, which is debt coverage service ratio loan, which basically you want to get 1.25, meaning for every dollar of debt, you have $1.25 of income coming in based on certain stuff, right? But oftentimes what happens is it's very cheap to refinance those deals. You can kind of do it at a moment's notice. For instance, I'm going to be refinancing my mortgage here coming up. I'll be resetting my 30-year mortgage with very little cost associated to the deal. But when you contrast that to the multifamily world, it's incredibly expensive to unfortunately refinance. So you could be in a world in which, you lock in a deal today. Let's just say you locked in debt at 6% flat fixed rate for 7 years. And now, you base that off the treasury. And then let's say you floated and, it's floating's at 6.5 and kind of Fed cuts rates, they control SOFR, that starts going down and down. Well, you get the benefit of that, of the rates going down. You don't in the fixed perspective. But at the same time, you can exit that deal. Let's say if the market goes gangbusters because debt got a lot better, whatever may going on, there's growth and such. You can exit that deal or refinance that deal into fixed rate for a substantially less cost than when you're in a fixed rate deal. Let's say you locked in a 6% interest rate and debt went really low. Maybe now debt's at 4%. Well, it's going to be very expensive, on that prepayment penalty there to leave that deal there if you're an investor, if you're a sponsor there. So sometimes it does make sense, but it's not as easy when you are locked in on fixed rate debt. So, that's unfortunately, that's the world of nuances and complexity that is investing, that, there's not always a one size fits all equation. We obviously do like the easy nature of fixing and not having to worry about it. But as we say, if it's below 6, you fix. So, it's just, there's a lot more thought that goes into these equations that people may not realize, and a lot of kind of give and a take, like any investment, any opportunity cost situation presents you with. You have options, and, there's more than one route to take it. Awesome. Switching gears now onto kind of recessionary thoughts here, Rob. You know, are we in a recession? Are we not in a recession? It's such a precarious time in our cycle here.
Yeah, it feels like it. I think we are. I think sentiment is there, and I think tariffs were the straw that broke the camel's back to really be the exogenous trigger to actually go into recession. But then that kind of was paused for 90 days. We'll see. We'll see kind of how everything goes. I don't know if we can put the genie in the bottle fully, but perhaps it's possible. So, yeah, I think we are. And I think that's why there's a bias towards lower rates over the next year or so. So, if I were you, I wouldn't be in a crazy rush to refi your mortgage because I think rates are only going down.
Yeah, I'm not. I'll have the money coming up from the incredible refinance that we'll be doing here on Preserve. But I'm certainly checking the market here to see what makes sense, and can certainly hold the going up on the payment on my end there, of course, personally. But I thought this was a very good episode, Rob. Very nutrient dense, very much so topical to the sign of the time. So hopefully this will help you navigate for those, or navigate kind of where we're on in the market, for you to get some more clarity here. For those who are wondering, unfortunately, we do not have a deal that we can send you right now. We've been getting not accosted, but people are reaching
Bombarded.
out left and right looking for, when Lone Star is a deal next. We're very grateful for that. We put a lot of work in to make sure there's demand, but sadly, there's nothing on hand that I can show you right now, but hopefully that will change soon. For all those who are listening, we appreciate your time today. Thank you so much for tuning in. If you can maybe like this video, share this video with someone who might find this to be helpful, subscribe, the whole jazz. That would be very appreciative, very much so appreciated on our end. And if you're looking more to learn more and maybe attend our West Coast Summit on April 25th, we would love to have you in the Bay Area, assuming you're a passive investor. It would make sense for the room. And then similarly, our New York City event, 14th to 15th, we've got someone who's a stickler, who may or may not be in this presentation, this podcast episode with today here with me, making sure and gatekeeping the room to his best ability. But we would potentially love to have you come. Can't say we would love to have you come because we haven't seen your application yet, but we're looking forward to that being the best iteration of the version yet. Thank you so much for listening, and we will see you next week.